Hi, everyone. I'm delighted to welcome you to another episode of Be Limitless. Isn't it intriguing how God's created human life as a large, complex puzzle in which only two pieces are known? One, that we are, and the other, one day we won't be. But in between lies a life full of hopes, dreams, experiences, emotions, and aspirations. We live it without a clue about what's coming up next. Wouldn't it be nice to be able to secure or ensure some of the important pieces of this puzzle called life? Which brings me to the industry we are covering today, life insurance. We bring you a pioneer in the life insurance space in the private sector, who is not only the largest private sector player by market cap, but is also the only insurance company listed in the Nifty 50 currently, and the first to do an M&A in this space, HDFC Life. It is my pleasure to welcome Vishal Subharwal, the head of marketing, commerce, e-commerce, and digital, to talk to us today. And I'm going to ask him to tell us about the strategy that underpins HDFC Life's being limitless and streaming ahead. Welcome, Vishal.
Thank you so much, Sangeeta. It's a real privilege and honor to be on this platform. And let's shoot straight into it. Talking about the strategy of HDFC Life, we basically there are 5 elements to our strategy, right? This is something that we have consistently followed over the last decade or so. The first pillar is profitable growth as a company. And why profitable growth? Because it covers all stakeholders, including consumers, distributors, shareholders, and employees. Now, how do we go about delivering profitable growth? The first pivot here is a diversified distribution mix. Today, there are multiple channel partners, more than 300 channel partners that we have across banks, corporate agencies, brokers, online, and our own proprietary and direct sales force. The next piece is how do we expand the market by bringing in new age or cutting edge product innovations. So that's the third pillar of our strategy. The fourth pillar is oriented around consumer experience and how do we reimagine the entire life insurance value chain. So that includes elements of technology, data, machine learning, and so on and so forth. And the last but the most important piece is because we come from the HDFC group, our parentage is very strong. The quality of the board that we have is very, very strong and robust. And more importantly, we run with an independent management team. What it means that unlike other financial conglomerates, our management is actually committed to only this industry and this company, which is HDFC Life Insurance.
That's a wonderful overview. Thank you, Vishal. That's great. And what would you say? What business are you in? How would you define that?
Yeah. So we are in the business of offering protection and long-term savings instruments to individuals and in some cases to corporations as well. So life insurance essentially is a risk transfer mechanism. So as an individual, you transfer the risk from your personal balance sheet to a life insurance company, right? There are various kinds of risks that we cover. And, the chief among them being mortality risk. So the risk of dying at a very young age and therefore, your dependents are left, they don't have an income stream, right? And therefore second order effects of that. Right. Then there are other risks as well associated, and we can get into those details as we progress.
So it might be interesting for our viewers and listeners to actually know what are the various kinds of risks. I don't think as normal consumers, you figure out all the risks in life. Sure. We leave it to life insurers to do that.
Absolutely. I spoke about mortality risk. The second risk that we kind of speak about is morbidity risk, which means that you fall sick and therefore you cannot earn an income, or the cost of treating that illness, right? You spend a lot of money from your savings. So in India, roughly 3/4 of the health expenditure is out of pocket, which does not come from an insurance company. So we have, disease specific products out there to cover morbidity risks, to cover cancer, to cover cardiac, and so on and so forth, right? The third risk that we kind of speak about is longevity risk. What it means is people are living longer, given all the progression that has happened in the medical field, right? When we had independence as a country, maybe the average age was 40, now it is already 72. So a significant part of our lives is going to be post-retirement. So how do we ensure that we don't outstrip our savings during our retirement years, right? So that's the third piece. The fourth piece is about interest rate risks. Now, globally, we know interest rates are volatile. If you look at some of the developed markets, and for that matter, India as well, right? The interest rates used to be in the mid-teens. Now they are about 5-6% and 6.5-7%. They've kind of declined. So how does one protect oneself against interest rate risk? So these are the broad risks, and then there are other variants and products that we have. Inflation risk, for example, right? If you want to have an equity exposure and kind of ensure that your savings beat inflation or are protected against inflation, then you can buy unit-linked investment plans. So these are the various risks that we speak of.
And when we were talking about this in some detail, Vishal, I remember asking you whether these are tax-free. When you get when your insurance, let's say a term policy comes to term, and you get the money. And you mentioned that it is tax-free except for ULIPs, which are capped at a certain level. And doesn't that sort of make, things like Provident Fund and insurance really good instruments for earning above inflation, if you like?
See, India is an underinsured country. So the tax benefit which the government gives is actually a nudge to consumers to go out there and get protected. So that's the fundamental piece, right? Now, of course, if you get a death claim from an insurance policy, it is absolutely tax-free. Similarly, in the case of savings products, for example, if a person who's taken the life cover does not die, right? The proceeds which come to that individual are again tax-free. The only caveat which got introduced was in the previous financial budget was for ULIPs. This was capped at 2.5 lakh rupees per annum premium. So up to that, whatever you invest, the proceeds become tax-free. So yes, if you don't pay tax, obviously you kind of then, it comes straight to your savings account or bank account subsequently when the proceeds come. And that's an advantage that you enjoy by investing in life insurance.
Right. So you get a kick of 2-3% on that, depending on what tax bracket you are.
Absolutely. If you're at the highest tax slab, 5.5% return is equivalent to maybe an 8.5-9% return. So yes, that arbitrage.
And when we were talking, you mentioned that one of the differentiating features of HDFC Life is really the products on offer and the innovation pipeline that you have always on all the various products that you offer. And, I'll take you back to maybe 10-15 years ago. And I was very taken up with this line, Sar Utha Ke Jio. And I thought to myself, here's an enduring thought, baselining all insurance, where an average Indian would like to live his life, within whatever his earning capacity is, with the kind of self-respect that he wants, without having to borrow from friends, relatives, and without having to fall below his minimum level of standard of living, let me say. So I thought that was a really nice line to introduce, and I believe it's still around.
Yes, absolutely. So all our brand values and principles are rooted around Sar Utha Ke Jio, and it started in 2004. So 17 years and still going strong. Right? And as you kind of said, it's about self-respect, but we do believe that self-respect comes from financial independence, right? In today's world.
Right.
And that is where we come in with some of the product innovations that we bring to the table. So we've had a long history of product innovation to assure individuals, financial independence and self-respect. So for example, I spoke about morbidity risk. And the cost of cancer treatment is really, really huge. So we were the first life insurance company to introduce a cancer care product, for example, right? I spoke about longevity risk, right? We were the first insurer primarily to come out with a deferred annuity product. So, you may not want an annuity today, but you have a corpus today. So start planning for it, and you want it 5 years later, 10 years later, the pension to start a few years later, you can plan for it today. So these are the kind of innovations that we bring to the table. Some of our products are actually category brand names, right? So on the guaranteed savings side, we have a product called Sanchay Plus, which kind of mitigates your interest rate risk. Now, I mean, a lot of the distributors, when they go to a customer, they say, this Sanchay is, this is our equivalent of HDFC Life Sanchay. So that means it's become a flagship product.
Okay, right. That's a great place for a brand to be. Huh?
Absolutely. Right. So that's what product innovation is all about.
Right, and I think you also have a pension product, isn't it? Which is you have the largest pension product. Am I right?
So as a life insurance company, we do sell a lot of annuity products. A lot of it is under the pension guaranteed plan, but we also have created a separate pension fund management subsidiary. So it's under the national pension system. So where you can accumulate during your working years, deduct from your salaries, or make a contribution to the national pension system. So as long as you're working till about, the entry age has now been extended to 65 or 70 years. So you can keep on investing in that corpus. And whenever you want to draw a pension out, you can go to a life insurer like us and start your pension by buying an annuity.
Right. So I was looking at your slew of products, and there's a table I was looking at, and it's quite complicated. And I read that the term insurance space is a very competitive space. So it must be a lot of products must be out there in term insurance. And I was just hoping whether you can demystify one of these products for our viewers and listeners.
Sure.
Term insurance.
Yeah. I will explain the simplest of them all, which is term insurance.
Okay.
So term insurance is, fundamentally transfer of risk from yourself as an individual or from your family's P&L to a life insurance company. So today, if you're, let's say, 35 years old, you can pay, let's say, less than 1,000 rupees a month and get a 1 crore worth life insurance cover. Plain vanilla, simple, right? So once you decide the risk cover that you want, you then decide for how long you want that risk cover. So do you want a risk cover for the next 30 years? Let's say you're going to retire at 65. Or do you want that risk cover lasting till 75 years or 80 years, because 85 years, because you want to create a legacy for your family, right? So basically, that's what term insurance is all about. And in case you die, the insurance company pays you a claim of 1 crore, right? So you're paying less than 1,000 rupees a month, maybe 10,000 rupees per annum for an average Indian. The average age for an Indian today is about 30, 35 years old. So that's a plain vanilla term insurance product.
I saw in some of the communication that you've done that a lot of the insurance products, actually you speak of them being linked to life stages, and that would be very interesting for us to understand.
Yes. So, once you come into the working age, right, and you start earning, you become part of the insurable population, right? Basically, you're bringing a financial income stream to the family, and therefore you need to get a risk cover, right? So ideally, one starts with term insurance, right? So that the mortality risk is covered. So, and as you your responsibilities increase, right? So let's say you have children and you have to fund their education, right? Now, in the normal course, discipline savings becomes slightly difficult, right? Because, with some of the other products, there's a fancy to look at every day at what is happening in the scoreboard, right? And therefore deciding whether you want to get into the product or get out of the product, right? Whereas if you're planning for a certain goal, which is child's education or for your retirement, right? You start thinking about child's education typically in your mid-30s. You start planning for retirement when you turn about 45. So the first segment is the young aspirant segment. The second segment is the proud parents segment when you start thinking about children, and the last segment is the wisdom investor segment when you think about retirement. So that's how it pans out in terms of segmentation.
Very interesting. And I think you mentioned something which sort of stuck with me, saying that when you're young and healthy, you have a lot of financial responsibilities, but you don't have a lot of free cash flow. So you invest in a term insurance. That's your accumulation phase. And then later on, when you have more cash flow, you're later in your corporate journey or whatever, then you start to build on your goal set requirements for insurance. Child, like you said, child education or wedding. People sometimes save for a home or for a wedding.
Absolutely. So you need to have some disposable income for this. Typically, what we recommend about 15 to 20% of your disposable income you should keep aside for long-term savings or long-term goals, right? So.
Right. And the other interesting thing I read, and then we can move on to other things other than the product innovation piece, is you have an online suite of products. Would you like to talk about those, the click-to products?
Sure. So fundamentally, as a company, we believed e-commerce was going to be become bigger in the country as consumers come digital. Consumers would come online to research products initially and then subsequently go on to buy products, right? So we said, if we are covering the three risks of, let's say mortality risk to start with, we need to have a product on this platform. And therefore we have Click to Protect series of products. Right now it's called Click to Protect Life, which is our term insurance product. Then we have a savings and investment product, which is Click to Wealth. So you have a choice of 11 funds from which you can buy, equity funds, mid-cap funds, debt funds, liquid funds, right? So that's the second product. And the third product is a click to retire product. So you are very clear that you're buying into this product for retirement purposes. So that's the third product. So that's how the Click to Series product suite actually developed and is available on offer for all our consumers online.
Right. And an interesting thing you mentioned when I asked you, how does that compare with mutual funds? And you said that these products, you can actually change maybe every year. You can change the proportion you want to invest in equity or debt. Whereas if you did that in a mutual fund, you would have to stop that particular fund and start a new one. You'd have to enroll in a new product. So this gives you the flexibility to actually shift your portfolio around, right?
Absolutely. So one single product gives you the choice of 11 funds. So we allow for unlimited fund switches, between these funds in any given year. So there's no charge to you, and therefore no taxation. You don't have to go and evaluate another product. Once you have bought this product, you're free to make fund switches within the product itself.
So Vishal, just two aspects on this, and then we'll move on to something else. I read that during the pandemic, which is still on, it's a long pandemic, 99% of all the policies, not issued, but policies, I think researched or were online. Is that true? I mean, give it the right term. I'm missing that term.
Yeah. No, so obviously a lot of research does happen online, and consumers, when they're online, they tend to research more products than they would do when they were kind of face-to-face with a distributor. But definitely pretty much all the policies or all the consumers that we onboard today, either via our e-commerce platforms or via distribution platforms, they happen via technology enablement. And therefore, that statistic of 99% plus policies are onboarded in a digital manner or in an online manner. Because
isn't that amazing? It's a complete change, huh? Because there are a large number of distributors here. There are a large number of partners here. But
it's amazing that every distribution channel is at a different level of maturity. But what the pandemic did was, instead of looking at technology as a competitor, it became a toolkit for survival, right? Once it becomes a toolkit for survival and an aid to a distributor or to an agent, then the adoption automatically kind of scales up very, very rapidly. And that's what happened during the course of the last couple of years.
Right.
And as a company, we've also invested in these tools ahead of the curve. So the change management became easier because we had the platform, right? And some people were using it, but not all were using it. But given the pandemic, there was no choice left for everyone, right? So because business had to continue, and people had to earn their living, and people were demanding insurance, right? So that's how the technology scale happened.
So since we are on technology, let's go to that piece. you were ahead of the curve, you said very clearly. And technology has been your differentiator, yeah, from other insurance companies. And I read that it's about deep integration. It's not only about just connecting everything, but also about process integration. So do you want to just tell us a little bit about that?
Yeah. So there are a couple of things. Like if you look at what's happening in the environment, right? So we had the JAM trilogy, as we call it, Jan Dhan Aadhaar, mobile revolution, right? So the government is kind of giving a lot of push to it, and the government is very, very keen on digitization. So that's one piece. The other end of the spectrum was a lot of businesses are moving onto the cloud as they scale up, right? So that's the second piece. The third element is artificial intelligence, machine learning. Some of these tools have kind of come in over the last 4 or 5 years, right? And therefore, they can kind of give a lift both in terms of business revenues when you do analytics, as well as risk mitigation when you are underwriting policies, for example. And the last element is, how do you kind of service your distributors and your customers, right? Now, these could be chatbots, these could be tools which could give them an Insta response, and we call this the Insta suite, internally. So these are the tools, right, which have come in the last 4 or 5 years, and therefore it's not something that we have invested in the last couple of years. We started this journey about 5 years back, or in some cases 7 years back, right? We did a technology transformation program in 2012. We set up a dedicated e-commerce unit in 2013, with everything almost like a virtual unit within a large company. We set up a data labs and analytics team in Bangalore so that people could work at the cutting edge of some of these technologies. And we also kind of created a unit comprising of people who have worked in the startup world, and they came and worked for us in a unit called Accelerating Digital Change and Transformation. So it's called the AdCat unit. So that's how we've invested in people, processes, and technology to get this engine going. So it could be hyper personalization, it could be bots, it could be FaceTimer, it could be let's say credit bureau checks, it could be risk assessment, it could be propensity modeling to nudge consumers to buy a certain product. So there are a lot of things which technology can enable today.
Right. So you've clearly been ahead of the curve, and
yes,
that's how companies which are being limitless work actually and think about things. They are ahead of the curve.
And then some of these decisions are not easy because you have to put capital in advance, right?
Right.
And and you're taking away.
That's really early, 2012, 13. To have made all these investments. That's early. That's really early. No, that's fantastic. And but can we quickly go to distribution, which is a linked area? And you mentioned how you've provided the tools and technology to your partners to be able to pursue this journey aggressively. So would you like to just take us through? I believe you also have some non-traditional partners. So you have branches, you have partners, and you have non-traditional partners.
Yes. Right? So let me kind of break this down. So we run a proprietary sales force, which comprises of our branches, our agents, and then the entire infra to kind of support the agency workforce and the direct workforce that we have. The second channel is the bank assurance channel, which is where we work with our banking partners. The third platform is the broking platform, where we work with brokers. And brokers are allowed to partner with multiple insurance companies. Today, even banks are allowed to partner with 3 life insurance companies, 3 general insurance companies, and 3 standalone insurance companies. And then we work with the insurtechs and the e-commerce players of the world. So broadly, I would classify our distribution channels into these 4 buckets. Pretty much 300 plus partnerships, which is one of the largest which is out there in the industry. Outside the proprietary channels, including in bank assurance, we operate in an open architecture environment, which means in a lot of the banks that we work with, they're selling products of 3 life insurance companies. Whereas for some of our competitors, larger competitors, their banking partners would be selling only their insurance products because they're subsidiaries of the bank.
Okay.
So we are competing in a far tougher environment.
Yeah.
Yes. And the last leg that I spoke about, right? The fintech players, for example, the insurtech players, a lot of them see insurance as a great play. Because until now they've been payment platforms, for example, right? But they have to monetize that data. They have to move beyond payments, and therefore you see a lot of the pure play kind of payment aggregators of transaction platforms moving into insurance, both life and general insurance. What it means for us from a technology standpoint, an agent is operating in a different technology zone, whereas an insurtech or a fintech is operating in a different technology zone, right? And all of them have different kinds of demands. So with some of them, we can do very, very deep integrations. With the bank, let's say some data can flow in from the bank based on customer consent. Some data can flow in from some of our partners who do some of these checks. So those kind of integrations can work very, very well, but it totally depends on how mature the partner is.
Right. And then there's an interesting snippet that I picked up in our conversation, which was about how your distribution partners, as they penetrate into smaller markets, and as these markets actually get more infrastructure investment, which is happening from the government, the players will get deeper and deeper. There'll be more penetration coming in from the smaller towns and cities, and perhaps even from rural. And that's when you'd like HDFC Life to be their first choice, right?
Yeah, absolutely, right. So what is happening? If you track the financial inclusion index that the Reserve Bank of India publishes, that number is about 60 or thereabouts, right? Okay. It's moved up from 50 in the last couple of years, right? So with a lot of bank accounts opening, a lot of small finance banks are out there in these places. Even the large banks are going rural, right? So because of our 300 odd distribution partnerships, we start to get access to these markets, right? And therefore, when a lot of our partners onboard customers there, and these customers understand insurance, right? Life insurance, because the government is now saying, Pradhan Mantri Jeevan Bima Yojana, go to a bank, buy a 2 lakh rupee life cover, right? So they are educated about life insurance, but they ask, why only 2 lakhs? Why not 5 lakhs? Why not 10 lakhs? I have a house that I've created for 20 lakhs, right? And I have a home loan. So there is a liability against that house. I need to adequately cover myself in case something were to happen to me. So that's how the awareness of insurance, a lot of customers are coming into the fold because of the deeper penetration of financial services into these rural markets. So you don't necessarily have to physical branches. Right. Because of technology and the partnerships and the products that you have, you can reach out to consumers across India.
Right. And very quickly, remember we had a little chat about rural, and I believe about 20% odd of the policies are actually written in rural, right? Yes. Though it's difficult to make all these correct assessments, when you're called to pay out, right, in that space, because. Yes.
So roughly 1/5 to 1/4 of the policies at an industry level would happen in rural markets eventually.
Right. And I believe it's important to mention, you mentioned your payout ratio. And I think it's a very important aspect of building trust, right? And HDFC is a very trusted brand.
So the claim settlement ratio, right? The claim settlement ratio is a moment of truth, because every time I go out and pitch a product to a consumer, he asks me, okay, you're selling me a term plan. You're asking me to buy insurance cover, but how do I trust you? Right? You don't come with a sovereign guarantee. What is your track record as far as claim settlement is concerned? I mean, if you look at our history and our reported claim settlement ratio numbers, these have typically been in the 98 to 99% kind of a zone. So if you're settling 99% of all claims, and that includes death claims which are coming to you, that's a pretty high statistic, right?
Yeah.
And that's
you're living up to your promise, right?
Yes, living up to our promise. Right, because that's the moment of truth for a consumer and the nominee.
Right. So with so much going for you, what would you say is the potential for insurance in India? I know we are a highly underpenetrated country in terms of insurance, some 3-4%, right?
Yes.
Compared to
So let's start with a bit of the statistics first, right? So life insurance is roughly 3.3%, and then there's a bit of general insurance and health insurance on top of it as a percentage of the GDP. But also more importantly, we have to look at, at a per capita level, what is the life insurance coverage that we have? It's less than $60. When I say less than $60 in Indian rupees, it is just 4,200 rupees. Whereas the per capita income of India might be about $1,800, $2,000, right? Which is 1,60,000 rupees. So you're not even covered to up to one time your annual income, as a country, right? So if I look at some of the global benchmarks and I look at, let's say, the BRIC countries, so Brazil, China would be about 3 times to 5 times this number. If you go into advanced countries like Japan, America, this number is $1,800 or thereabouts. So we are at $60. The advanced world is at $1,800, right? So that's the scale of the opportunity. Against one other statistic, right? So, if you look at, let's say, about 6-7 crore taxpayers were there in India, right? And let's assume that, you're targeting these people, right? Even here, some of the data which has been put out by independent analysts says that only 1 out of 40 people have coverage or adequate, risk cover. So the scale of the opportunity out there is massive as far as protection is concerned. So that's the mortality risk. As far as longevity risk is concerned, which is around the pension assets. Yes. In India, the pension assets are less than 5%, about 4.5% of our GDP, right? Again, if you were to look at global benchmarks, advanced countries are at about 100% of the GDP, right? So, again, the maths out there is like 20-25 times growth, right? And this is going to be over multiple decades. And therefore, I say the runway for growth is kind of long. And the third statistic that we look at, right, is how much do Indian households save, right? Now, about, let's say, 60-70% of it might be in physical assets, land, gold, etc. So let's keep that aside, right? So we all know that value migration from physical assets to financial assets is going to happen. Even within financial assets, life insurance is only about 15%, right?
15%, yeah.
And 50% orders either with the banks or in currencies, right? So again, this provides us an opportunity to do migration, right? Whether from fixed deposits to our interest rate products. The equity components is low, but we still compete because of ULIPs with equities and mutual fund purchases. Right. A lot of opportunity overall.
Yeah, fantastic. So, this brings me to another question, Vishal. I was reading just the other day that the CDSL put out a statistic saying that in the last 1.5 years, and I'm talking September 21 back 1.5 years, the number of first-time players in the equity market has doubled, and they're very young people now joining that market. And we know that, of course, the recent flurry with the crypto and the NFTs, a lot of youngsters, around 20 years, are investing in those kind of products. So there's a lot of awareness about how can I not just keep my money in a bank, but how can my money earn me more money, right, through investment. And I was just wondering, where do the millennials fit vis-a-vis insurance?
Yeah, so I think this opening of demat accounts, cryptos, NFTs, right, this is a global phenomenon, right? And it's kind of, gone through the roof, not just in India, but also globally. And so I would say some of it is financial inclusion, which is happening because the younger customers are kind of not just opening bank accounts, but they understand the equity markets. They are able to understand and appreciate risk, right? So that's that's the good part, right? Because then they will understand, once they understand risk, they understand mortality risk, morbidity risk, and therefore what offerings insurance companies can give them. Right. Some of it is pure speculation. Okay.
Sure. I understand.
And insurance products are long-term savings and protection instruments. So we would probably not be competing necessarily in that space. I don't know if it's a fad or it's going to be a trend that is going to continue. As someone told me that every generation has its own South Sea bubble and Tulip Mania bubble. So let's see where this ends.
No, but I didn't mean that actually. What I meant was, the appetite, the discovery that there is risk in life, there is some money in life that you can invest, right? And that's younger and younger in India. And I think a large part of that is led by digitization and just the fact that it's created so much awareness amongst the youth. And so if the risk appetite of the country is changing, that obviously speaks well to insurance. So that was...
there's definitely greater awareness. And, the other plus I see is everybody who's coming into the insurable population today is aware of HDFC Life, as a brand. 20 years back, nobody was aware, right? So if more and more younger people are coming into this population and are transacting with financial products, HDFC Life has a great chance of being the insurer of choice for them.
Right. And that's what happens if you lead the market. So congratulations. And just a word on women participants. Recent ET news report said that 24% of women are now sort of buying life insurance products compared to some smaller number earlier. So anything around that?
Yeah, I think the industry number is about 1/3. It might vary by player.
Right.
But also importantly, I think women are co-decision makers in the insurance buying process. Buying of an insurance product is typically a family decision. At least two people are involved in the family, because you want to let your spouse know or your nominee know that you're buying this product. Otherwise, there's no benefit of buying a life insurance product if the nominee, whosoever the nominee is, and in most cases, it's going to be the spouse, right? Doesn't know that you're buying a policy, and therefore before buying the policy, they are kind of involved in this process of buying a product. A lot of the independent working women now have started attributing an economic value that they bring to the family, right? Because they're co-participants in terms of how the household expenses are run and so on and so forth. And therefore, these women understand term products and what it does to them, right? Because again, the mortality risk play comes there. So that's one element of women consumers. The other element is women who are concerned about children, what's going to happen to the children's education, and therefore save for them, right? So broadly, I'll bifurcate this into two buckets, right? Buying for self and buying for children. Right.
So very goal-oriented sort of insurance products. Yeah. No, that's amazing. So, when we spoke about opportunity, you said something very important, and I'm going to quote it. Vishal, you said, we promise to penetrate the market, but to go on a smooth upward curve, not volatile in terms of growth or financial performance, managing solvency and risk. And I think that is a wonderful statement of purpose. That we will go on extending and covering more and more policyholders so that families are saved from financial distress or extreme financial distress, where literally life comes to a halt. Right? You can't even pay the fees for your child's education. But continue to penetrate on a smooth upward curve and with good financial performance, managing the solvency risk. So it'd be good for all the stakeholders as well.
Absolutely, because it's a business of trust, it's a business of solvency, it's a business of claim settlement, right? So we need to understand the risk that we are writing, and therefore, it's easy to buy growth in the financial sector, as in go and expand distribution, open branches all over the country,
understand,
onboard consumers, right? But risk management becomes really, really critical. So that's why the smooth upward curve thing.
And Vishal, in conclusion, I would say, as a consumer, you can live a limitless life if you have the assurance of a life insurance or some life insurance behind you. And it's been wonderful, talking to you. And I wish you all the very best.
Thank you so much, Sangeeta, once again, and real honor and privilege to be here. And, life insurance is not just for oneself, right? It's not just your life, which is limitless. Actually, your legacy will also become limitless. So that's where
Thank you.
Grandchildren and future generations will also remember.